Listen up, the government just rolled out a massive update to the tax code for 2026. And buried inside are some of the biggest changes we've seen in years. I'm talking new deductions, supercharged credits, and higher contribution limits that could be worth thousands or even tens of thousands of dollars to you. But here's the brutal truth. Most people are going to overpay on their taxes simply because they don't know these new rules exist. They'll just unknowingly leave a massive tip for the IRS. Today, that stops for you. I've spent weeks dissecting these 2026 changes, and the opportunities for everyday Americans, from W-2 employees to early retirees and families with kids, are staggering. The problem is, the system isn't designed to help you pay less. It's designed to collect what you owe, and it will happily accept more if you offer it. This video is your defense against that. I'm going to give you a step-by-step playbook of 13 specific, legal, and IRS-approved tax strategies you can use right now to keep thousands more of your hard-earned money in 2026. We are not talking about gray areas or aggressive loopholes. These are clear, actionable moves the tax code explicitly allows. So grab a notepad and let's dive into number 1. Number 1. Maximize your pre-tax retirement contributions. Alright, let's start with the single most powerful and accessible tax-saving tool for most working Americans: your workplace retirement plan, like a 401k or 403b. For 2026, the IRS has handed you a golden opportunity by increasing the contribution limits. You can now contribute up to $24,500 of your salary into your plan. If you're age 50 or over, you get to add a catch-up contribution of $8,000, bringing your total to a whopping $32,500. But what does that actually mean for your wallet? Every single dollar you contribute pre-tax is a dollar you get to deduct directly from your taxable income. Let's make this real. Imagine you're in the 24% federal tax bracket. If you increase your 401k contribution by just $5,000 for the year, you have instantly lowered your tax bill by $1,200. That's money that stays in your pocket, not the government's. You didn't just save it, you invested it for your future self, where it can grow tax-deferred. And this doesn't even account for state taxes, which could add hundreds more to your savings. This move is for anyone with access to an employer-sponsored retirement plan. The how is incredibly simple. You don't need a CPA for this. Log into your company's payroll or benefits portal, the same place you might check your pay stubs, and find the section for your 401k contributions. Bump up that percentage. If you just got a raise, a fantastic micro strategy is to allocate half of that raise directly to your 401k. You'll never even miss the money from your paycheck, but your retirement account and your tax bill will see a massive difference. And please, at a minimum, contribute enough to get your full employer match. Anything less is walking away from free money. Number 2. Unlock the triple tax advantage of a health savings account, HSA. Moving on to our second strategy, which I consider the undisputed champion of all tax-advantaged accounts, the health savings account, or HSA. If you're eligible for an HSA and you aren't maxing it out, you are making one of the biggest financial mistakes possible. It is the only account in the entire tax code that offers a triple tax advantage. The money goes in tax deductible, it grows tax-free, and it comes out tax-free for qualified medical expenses. For 2026, the contribution limits have increased. You can now contribute up to $4,400 for self-only coverage, or a massive $8,750 for family coverage. If you're age 55 or older, you can add another $1,000 as a catch-up contribution. Let's run the numbers. A family in the 22% tax bracket maxing out their HSA at $8,750 gets an immediate federal tax deduction that saves them $1,925. That's nearly $2,000 back in their pocket for the year, just for funding an account for medical expenses they'll likely have anyway. But the real power is using it as a long-term investment vehicle. Many people don't realize that you can invest the funds within your HSA just like a 401k. Imagine letting that $8,750 grow for 20 years. It could easily become $30,000 or more, and when you need it for medical expenses in retirement, which you will, every penny comes out completely tax-free. Who is this for? You must be enrolled in a high-deductible health plan, HDHP, to be eligible. Many employers offer these, and they're becoming more common. The steps are straightforward. First, confirm you have a qualifying HDHP. Second, open an HSA. Your employer may offer one, but you can also open one at many financial institutions, which might offer better investment options. Then, set up automatic contributions from your paycheck or bank account. This is a non-negotiable strategy for anyone eligible. Number 3. Harvest your losses to offset your gains. Our third strategy is a bit more sophisticated, but it's an incredibly powerful tool for anyone with a taxable investment account: tax loss harvesting. The concept is simple. You strategically sell investments that have lost value to realize a capital loss. You can then use that loss to cancel out, dollar for dollar, any capital gains you've realized from selling winning investments. Let's say you sold some stock this year and have a $5,000 capital gain. Normally, you'd owe taxes on that. But let's say you have another investment in your portfolio that's currently down by $5,000. You can sell that losing investment, harvest the $5,000 loss, and use it to completely wipe out your $5,000 gain. Your tax bill on that gain is now zero. What if your losses are greater than your gains? Even better, you can use up to $3,000 of excess capital losses to deduct against your ordinary income, your high-tax salary each year. If you have more than $3,000 in losses left over, you can carry them forward to future years to offset future gains or income. This is a completely legal, IRS-approved way to turn your portfolio's losers into a tax-saving advantage. This strategy is for anyone with a non-retirement investment account, like a brokerage account. It's especially powerful if you rebalance your portfolio or have a mix of winning and losing positions. The key rule to watch out for is the wash sale rule. You cannot sell a security at a loss and then buy that same or a substantially identical security within 30 days before or after the sale. If you do, the loss is disallowed for tax purposes. So, the process is: review your portfolio for losing positions, sell the loser, and either wait 31 days to repurchase it or immediately reinvest the money into a different, non-identical investment, like a different S&P 500 ETF from another provider. Number 4. Use strategic Roth conversions in low-income years. Strategy number 4 is a proactive move to manage your future tax bill, especially for those who anticipate being in a higher tax bracket in retirement. It's the strategic Roth conversion. A Roth conversion is when you take money from a traditional pre-tax retirement account like a traditional IRA or 401k, pay income tax on that money today, and move it into a Roth IRA or Roth 401k. Once the money is in the Roth, it grows 100% tax-free, and all qualified withdrawals in retirement are also 100% tax-free. Why would you voluntarily pay taxes now? Because you are controlling the tax rate. The ideal time to do this is during a dip year for your income. Perhaps you're between jobs, starting a business that isn't profitable yet, or have just retired but haven't started taking Social Security. In these years, your income might fall into the 12% or even 10% tax bracket. Here's the play: you convert just enough money from your traditional account to fill up that low tax bracket. For example, in 2026, the 12% bracket for a single filer goes up to an income of $50,400. If your taxable income for the year is only $20,000, you have over $30,000 of room in that 12% bracket. You could convert $30,000 from your traditional IRA, pay only 12% tax on it today, and move it to a Roth IRA. In the future, that $30,000 and all its growth are yours tax-free, avoiding what could be a 24%, 32%, or even higher tax rate down the road. This also reduces the balance in your traditional accounts, which lowers your future required minimum distributions, RMDs, giving you more control over your taxable income in retirement. This is for individuals who expect their income to be higher in the future than it is today, or those who want to create a source of tax-free income in retirement. You simply contact the brokerage firm holding your IRA and instruct them to convert a specific dollar amount from your traditional IRA to your Roth IRA. They'll handle the transaction, and you'll be responsible for paying the tax on the converted amount when you file your return. Number 5. Bunch your itemized deductions. With the standard deduction being so high, fewer people are itemizing. For 2026, the standard deduction is $16,100 for single filers and $32,200 for married couples filing jointly. This means that unless your itemizable expenses, like state and local taxes, mortgage interest, and charitable donations, exceed this high bar, you get no additional tax benefit for them. Strategy number 5, bunching, is the legal way to get around this. Bunching involves timing your deductible expenses so that you concentrate them into a single year. By doing this, you can push yourself over the standard deduction threshold in 1 year, allowing you to itemize and get a large deduction. In the following year, or even 2, you just take the easy-peasy standard deduction. Let's look at an example. A married couple has about $10,000 in property and state income taxes and donates $10,000 to charity every year. Their total itemized deductions are $20,000. Since this is way less than the $32,200 standard deduction, they just take the standard deduction each year and get no extra tax benefit for their generosity. Using the bunching strategy, in late 2026, they could make their 2026 and 2027 charitable donations at the same time, totaling $20,000. Combined with their $10,000 in state and local taxes, their itemized deductions for 2026 are now $30,000. If they can find a few more deductions like medical expenses, they could easily surpass the $32,200 threshold. Let's say they hit $35,000 in itemized deductions for 2026. Then in 2027, having already made their donation, they would simply take the standard deduction. Over 2 years, this strategy lets them claim a much higher total deduction. A great tool for this is a donor-advised fund, DAF, where you can make a large tax-deductible contribution in 1 year and then grant the funds to your favorite charities over several years. This move is for anyone whose annual itemized deductions are hovering just below the standard deduction threshold. Number 6. Don't overlook the saver's credit. This next one is one of the most tragically overlooked opportunities in the tax code, especially for those with low to moderate incomes. It's the retirement savings contributions credit, better known as the saver's credit. This isn't a deduction, it's a credit, which is way more valuable. A deduction just reduces your taxable income, but a credit slashes your tax bill dollar for dollar. The saver's credit is literally free money from the government designed to reward you for saving for retirement. Depending on your adjusted gross income (AGI), you can get a credit for 50%, 20%, or 10% of the first $2,000 you contribute to a retirement account, $4,000 for married couples. This means a potential max credit of $1,000 for single filers or $2,000 for joint filers. For 2026, to be eligible, your AGI must be below $40,250 if you're single or $80,500 if you're married, filing jointly to get at least the 10% credit. Think about a young person just starting their career or a family with one spouse staying home. Let's say a married couple has an AGI of $75,000. They are eligible for a 10% credit. If they each contribute just $2,000 to their respective IRAs or 401(k)s, they get a $400 credit on their tax return. They were going to save that money anyway, and the government is giving them $400 back just for doing it. This is a must-claim credit for students, part-time workers, and any individual or family within the income thresholds who is contributing to an IRA or a workplace retirement plan. To claim it, you just need to file Form 8880 with your tax return. Most tax software will automatically flag this for you if you enter your retirement contributions and your income qualifies. Do not leave this free money on the table. Number 7. Harvest the 0% capital gains bracket. Most investors are familiar with capital gains taxes, but very few know about the 0% capital gains bracket. That's right, you can potentially sell winning investments and pay absolutely zero tax on the profits. This is a phenomenal opportunity for people in a low-income year, like retirees, students, or someone in a transitional career phase. Here, how it works. Long-term capital gains, profits from assets you've held for more than 1 year, are taxed at different rates than your ordinary income. For 2026, if your total taxable income, which includes your salary, interest, and the capital gains themselves, is below $49,450 for a single filer or $98,900 for a married couple filing jointly, your long-term capital gains rate is 0%. Imagine you're a retired couple. Your taxable income from pensions and Social Security is $70,000. You have a stock you bought years ago that has appreciated by $20,000. If you sell the stock, your total taxable income would be $90,000, $70,000 plus $20,000. Since $90,000 is below the $98,900 threshold for married couples, the entire $20,000 gain is taxed at 0%. You owe nothing to the IRS on that profit. This is a powerful tool for supplementing your income in retirement. You could strategically sell just enough appreciated stock each year to stay within that 0% bracket, creating tax-free cash flow. This strategy is perfect for retirees and anyone who has a temporary drop in income but holds appreciated assets in a taxable account. The key is planning. You need to calculate your projected taxable income for the year and figure out how much space you have left in that 0% bracket. Then, you can selectively sell your long-term winners to fill that space. Alright, we're about halfway through, and I hope you're already seeing how much money you could be saving. If you're finding this valuable, do me a quick favor and hit that subscribe button and click the notification bell. Tax laws are always changing, and my goal is to keep you updated with strategies just like these so you never overpay again. Also, let me know in the comments which of these strategies you think will save you the most money. I read every single one. Now let's get back to it with strategy number 8. Number 8. Maximize the child tax credit. For all the parents watching, this one is for you. Strategy number 8 is about making sure you maximize the child tax credit (CTC). This is one of the most significant credits available to families, and for 2026, the credit is worth up to $2,200 for each qualifying child under 17. Even more importantly, up to $1,700 of this credit is refundable, meaning that even if you owe zero tax, the government could still send you a check for that amount. A credit is a direct dollar-for-dollar reduction of your tax bill. So if you have two qualifying children, that's a potential $4,400 sliced directly off your taxes. This isn't a deduction, it's a powerful cash-in-hand benefit. The full credit is available to married couples with a modified adjusted gross income, MAGI up to $400,000, and for all other filers with a MAGI up to $200,000. The key here is understanding the qualifying child rules, especially for those in shared custody situations. The IRS has tiebreaker rules to determine which parent can claim the child, and it's crucial that you and your co-parent are on the same page. Typically, the parent the child lived with for more than half the year gets to claim the credit. However, the custodial parent can release the claim to the non-custodial parent by signing Form 8332. Planning this out can have a huge financial impact for both parents. This is obviously for parents with children under 17 who meet the income requirements. The action step is to ensure your child meets all the dependency tests: age, relationship, residency, and support. If you're in a shared custody arrangement, have a clear conversation and legal agreement about who will claim the child each year. Don't let a simple misunderstanding lead to a stressful IRS inquiry. Number 9. Claim time-sensitive energy efficiency credits. Strategy number 9 is urgent because the clock is ticking. The government introduced some incredibly generous tax credits for making your home more energy efficient, but many of these are scheduled to expire or phase out after 2025. If you're considering any home improvements, doing them now could translate into thousands of dollars in tax savings. There are two main credits to know. First is the Residential Clean Energy Credit, offering a 30% credit for the cost of new, qualified clean energy property like solar panels, solar water heaters, and geothermal heat pumps. This is a huge incentive. A $20,000 solar panel system gets you a $6,000 credit directly off your taxes. Unfortunately, under current law, this credit expires for property placed in service after December 31, 2025. The second is the Energy Efficient Home Improvement Credit. This provides a credit for other energy-saving upgrades like new exterior windows, doors, insulation, and high-efficiency heat pumps. This credit is generally 30% of the cost, capped at $1,200 per year. This credit also expires for property placed in service after December 31, 2025. This is for any homeowner planning to make upgrades. If you've been putting off replacing those drafty old windows or thinking about solar, you need to act before these credits disappear. The process is to purchase and install qualifying equipment, save your receipts and the manufacturer's certification statements, and then claim the credit by filing Form 5695 with your tax return. The window of opportunity is closing fast. Number 10. The home office deduction done right. With the explosion of remote and hybrid work, the home office deduction is more relevant than ever. But it's also one of the most misunderstood. This deduction lets you write off a portion of your home's expenses like mortgage interest, insurance, utilities, and repairs against your business income. There are two crucial things to know. First, this deduction is primarily for self-employed individuals, freelancers, contractors, small business owners. W-2 employees, even if they work from home full-time, generally cannot claim this deduction as of 2026. Second, you must meet two strict tests: regular and exclusive use, and your home must be your principal place of business. This means you have a specific area of your home, like a spare room, that is used only for your business on a regular basis. There are two ways to calculate the deduction. The simplified method is easiest. You deduct $5 per square foot of your home office up to a maximum of 300 square feet for a max deduction of $1,500. No need to track actual expenses. The second is the actual expense method. Here, you calculate the percentage of your home used for your office, e.g., a 150 square foot office in a 1,500 square foot home is 10%. You can then deduct 10% of all your eligible home expenses. This method is more work but can result in a much larger deduction if you have significant expenses. This is a critical deduction for anyone who is self-employed and works from home. The action step is to designate a specific area for your business and use it exclusively for that purpose. Take a picture of the space to document it. Then at your end, decide which method, simplified or actual, gives you the bigger deduction. If you choose the actual expense method, be meticulous about keeping records of all your home costs. Number 11. Maximize education tax breaks and 529 plans. Strategy 11 focuses on education, which can be one of life's biggest expenses. The tax code offers powerful ways to soften the blow. The first is through education credits. The American Opportunity Tax Credit (AOTC) is the most valuable, offering up to $2,500 per eligible student for the first 4 years of higher education, with up to $1,000 being refundable. The Lifetime Learning Credit LLC is another option, offering up to a $2,000 credit per tax return for courses taken to acquire job skills. You can't claim both for the same student in the same year, so you have to choose which one makes the most sense. The second and maybe more powerful long-term strategy is the 529 plan. These are state-sponsored investment accounts that are a supercharged way to save for education. While you don't get a federal deduction for contributing, your money grows completely tax-deferred, and withdrawals are 100% tax-free when used for qualified education expenses, which now include not just college, but also K-12 tuition up to $10,000 per year and even some student loan repayment. Plus, over 30 states offer a state income tax deduction or credit for contributing to their 529 plan. You can also make a large, gift tax-free contribution. For 2026, you can contribute up to $19,000 per year to a beneficiary without gift tax issues, or you can even superfund a plan by making 5 years' worth of contributions at once. That's $95,000 to kickstart a child's or grandchild's education savings. This is for parents, grandparents, or anyone wanting to save for education costs. The steps are simple. Research and open a 529 plan. Your state's plan is often a good place to start for the tax deduction, and set up automatic contributions. For the credits, make sure you receive Form 1098-T from the school and file Form 8863 with your taxes. Number 12. Make your charity go further with appreciated stock. Our 12th strategy elevates your charitable giving from simple cash donations to a sophisticated tax-saving maneuver. If you have stocks or mutual funds in a taxable brokerage account that have grown in value, donating that stock directly to a charity is one of the most tax-efficient ways to give. Here, why? Let's say you bought stock for $2,000 and it's now worth $10,000. If you sold that stock, you'd have an $8,000 long-term capital gain and would owe taxes on it, likely $1,200 if you're in the 15% capital gains bracket. Then, if you donated the remaining cash, you'd get a deduction for that amount. But if you donate the $10,000 worth of stock directly to the charity, two amazing things happen. First, neither you nor the charity ever pays the capital gains tax on that $8,000 of growth. It just vanishes. Second, you still get to take a full fair market value deduction for the entire $10,000, assuming you itemize. You get to deduct money that you were never even taxed on. It's a powerful win-win. For retirees, there's an even better strategy. The Qualified Charitable Distribution (QCD). If you are age 70 or older, you can donate up to $111,000 for 2026 directly from your IRA to a qualified charity. The amount you donate counts toward your required minimum distribution (RMD) for the year, but it is excluded from your taxable income entirely. This is better than a deduction because it lowers your AGI, which can help you avoid higher Medicare premiums and other income-based phase-outs. This is for anyone who gives to charity and holds appreciated investments or is over 70 with an IRA. To do it, contact your brokerage and ask them to initiate a direct transfer of shares to the charity or a QCD from your IRA. Do not sell the stock first. The asset must be transferred directly. Number 13. Optimize your withholding and estimated payments. Our final strategy is about one simple thing: stop giving the government an interest-free loan all year. This is the crucial act of optimizing your tax withholding. A lot of people get excited about a big tax refund, but a refund is just proof that you had too much tax taken out of every single paycheck. You gave the IRS your money, and they're just giving it back to you months later with zero interest. With all the new deductions and credits for 2026, your old Form W-4 at work is probably outdated. If you plan to max out your HSA or claim a larger child tax credit, you need to update your W-4 to reflect that. This will reduce the tax withheld from each paycheck, putting more money in your pocket immediately. The IRS has an excellent tax withholding estimator tool on their website. You can plug in your income, dependents, and plan deductions, and it will tell you exactly how to fill out your W-4 to get as close to a zero refund as possible. For those who are self-employed, it's about making smart estimated tax payments. The goal is to pay just enough to avoid an underpayment penalty. The safe harbor rule is your best friend here. Generally, as long as you pay in at least 90% of your current year's tax liability, or 100% of your prior year's tax liability, 110% if your AGI is over $150,000, you will avoid any penalties. By paying in just the safe harbor amount, you get to hold onto your cash longer, earning interest on it yourself instead of letting the Treasury do it. There you have powerful, legal, and actionable tax strategies for 2026. We've covered a lot, from maxing out your 401k and HSA to leveraging Roth conversions and harvesting tax losses. The key takeaway is this: taking control of your taxes isn't about finding sketchy loopholes. It's about understanding the rules the government itself created and using them to your full advantage. You work far too hard for your money to give any more of it to the IRS than you are legally required to. Pick 2 or 3 of these strategies that apply to you and start putting them into action today. Don't wait until next April. Proactive tax planning is the key to building real wealth. As a final step, I strongly encourage you to use the free tools on the IRS website, especially the withholding estimator, to get your numbers right. And while this video is a great starting point, it's not a substitute for professional advice tailored to your unique situation, so always consider talking with a qualified tax professional. If you want me to do a deep dive on any one of these topics like Roth conversions or donor-advised funds, let me know in the comments below. Thanks for watching, and I'll see you in the next video.